If you're a veteran or pilot, listen up. You're going to recognize a lot of what I'm talking about on this pod. All branches of the military use ORM or some type of operational risk management system. It's an imperative before launching any mission and commonly used by pilots in making go, no-go decisions. We identify the risks, even those with low probability. You make a judgment on the potential for success or failure, and then make a decision. The market battle of 2023 has already started, and before you venture into the market, you need to do a full operational risk management review of your stocks, bonds, and any other asset classes you're holding. People, this is your go, no-go checklist. Welcome to The Money Runner. I'm David Nelson. The consensus view is that the Fed will hike 25 basis points at the next two Fed meetings with an outside possibility of a third, letting time do the rest of the work for them. The problem, of course, with the consensus view is that it's often wrong. What it does do is give us a starting point knowing full well that the playbook will have to be rewritten several times during the course of the year. Before we can talk about this year, we have to go back and look at a few things from 2022. At the start of last year, we were looking at a potential 3.5% terminal rate. That's the peak rate for Fed funds expected by investors. Well, that didn't age well. And today that number stands a lot closer to 5%. This chart of Fed funds going back a half century is an eye-opener. Any student of history would have to at least consider 5% as well below what was necessary in previous inflation cycles. The Fed knows this, and that's why they've been so reluctant to give clear guidance on future rate projections. Last thing Fed Chair Jay Powell wants to do is box himself in. The Fed's current mandate is to kill momentum in the job market, making Wednesday's jolts and Friday's non-farm payroll data key to this month's performance. The number of job openings could come in well below 10 million, but that would still be elevated in comparison to pre-pandemic levels of 2019. Look, there's no shortage of factors that will drive portfolio performance and style this year. Geopolitical concerns not going away. We still have a raging war in Europe, and last week's near mid-air collision between the U.S. and Chinese military aircraft over the South China Seas shows tensions between the two remaining superpowers are running hot, red hot. All of the above are risks, but the elephant in the room is still the Federal Reserve, and with it, the risk-free rate. Most valuation models start with the risk-free alternative, and with short-term treasuries yielding well above 4%, the growth necessary to support high multiple growth stocks is just that much higher. Hence, the massive underperformance of long-duration equity last year, in particular, the very popular FAANG trade. The good news is that all of these stocks trade at significantly lower multiples today, some even approaching that of the broad market. When rates rise, appetites change. Investors hunger for yields in all its forms. Dividend, earnings, and free cash flow yields are high on the list of what investors crave when the competing risk-free rate is elevated. So what does this all mean for today's investors as we head into 2023? The good news, you have choices now. For more than a decade, the Federal Reserve has pushed investors further and further out on the risk curve. There is no alternative became the rallying cry of investors willing to pay almost anything for growth, and they weren't wrong. From 2017 to 2021, growth outperformed value by a staggering 119%. All of that changed last year when inflation took off and rates started to rise. We don't have to be stock-centric anymore. With short-term treasury yields approaching 5%, cash isn't trash anymore. Even gold deserves a look. The dollar is well off its highs, and the collapse of crypto has forced investors back into gold, looking for an alternative to fiat currencies like the US dollar. If we don't get a recession this year, it would be the first time in a half century a yield curve this inverted got the prediction wrong. All right, that's my view. What's the counter thesis? Where could I be wrong? Well, we're coming into earnings season. Just about to start a couple of weeks from now, banks will start to report. And given how far analysts have cut numbers, an upside surprise isn't out of the question. Remember, an earnings report is also a report card on how good or bad the analysts were at getting the number right. With shorts pressing, any positive news here could cause an upside surprise. Let's call that miracle number one. Any surprise in the job market could spark a massive rally. We get a low JOLTS number or a soft payroll number, stocks are going to explode. Miracle number two. Finally, the 100-to-1 shot. Peace in the Ukraine. Yeah, I know peace looks out of the question, but all options need to be considered. Putin's health is rumored to be failing, and the possibility of negotiations, while small, aren't zero. That would be miracle number three. Bottom line, a lot of valuation risk has been taken off the table, but we're still not out of the woods on inflation or rates. Look, I get it. Conditions aren't ideal for investors. They almost never are. Markets often have a habit of surprising us with something we haven't even thought of. I'm going to give the mission a go. If this was the Pentagon, I'd put our defense condition at, let's call it DEFCON 3. So people, let's be careful out there. If you like the pod, and even if you don't, hit subscribe. We might surprise you and get better. And don't forget, comments good and bad, we like them. Thanks for joining. I'm David Nelson.